There's sometimes some confusion on the difference between valuation methods that insurance companies use for property coverage, and I'd like to talk specifically about commercial property coverage today, although personal lines is very similar except for a few caveats. Insurance companies need a method or a fair means of valuing your property at the time of an insurance loss. Those two methods are replacement cost valuation and actual cash value. Replacement cost valuation is really exactly like it sounds. We will pay or the insurance company will pay up to the policy limit to replace your property with like, kind, and quality for its replacement cost at the time of loss. So if a building is built in the year 2000 for, say, $100,000, in the year 2010, 10 years later, it might cost $150,000 to replace that same building, and so we will pay $150,000 if you have indeed increased your policy limits accordingly to keep up with the inflation of replacement cost. We will pay that $150,000 that it takes to replace it, because that's the replacement cost at the time of loss. Actual cash value is defined as replacement cost less depreciation. So at the time of loss, the insurance company will pay up to the policy limit to replace your property with like, kind, and quality for its replacement cost less the depreciation. So same example, building built in year 2000. In the year 2010, the replacement cost, of course, is a lot higher, but the depreciated value is quite a bit less. So if it's depreciated at 3% a year over 10 years, it would be 3% each of those 10 years, the depreciation amount would be. So we'll subtract that off the amount that we're going to pay to replace. So here's a real-world example. Industrial Machine Inc. Purchases a plot of land and builds a new shop for $1.2 million. They know exactly what it costs to rebuild, because, of course, they've just built a building, should they have a loss. So they decide to insure it to the full value using replacement cost valuation. Each year they continue to update their coverages to keep pace with rising steel costs, construction labor, etc., so that at any point in time in the future they know that they have the full amount of coverage needed to rebuild should they have a loss. Real-world example number 2 is Cool Computer Parts Incorporated finds an incredible deal and purchases a 3,600 square foot building on Main Street, Anytown, USA that needs a little work for $160,000. It has a storefront for their business and apartments they can rent in the upper floors. The mortgage is only $130,000, so of course that's all the bank is going to require. Cool Computer Parts decides that the depreciated value of this building is probably $240,000, so they insure it for that value, ACV, and are not going to be bothered to rebuild it if they have a total loss. The problem is what happens during a partial loss. Well, let's assume that the actual replacement cost for this building is $480,000, which is a reasonable amount for a 3,600 square foot building. It's about $130 a square foot, which would be a reasonable reconstruction cost. If replacement cost less depreciation is $240,000, that means about half of our building, or 50% or so, has been depreciated away. But that doesn't concern us too much because we still have $240,000, our policy limit, left, which was about, or a little more than what we paid for the building, and it's about the market value of the property. The problem is, what if we don't have a total loss? Maybe a kitchen fire in a third-floor apartment causes $200,000 in property damage. Since we've only insured to ACV, replacement cost less depreciation, the insurance company will only pay the depreciated amount, $100,000. The building owner somehow has to find a way to come up with that additional $100,000. The city's not going to allow you to have a property with a third floor burnout, and third floor fire more than likely came through the roof, and so you have weather coming in. So the building needs to be repaired. Unfortunately, you've already borrowed 80% of the market value from the bank, so you can't get any more money from the bank. You may be able to go through some kind of private financing, but basically you're asking someone to lend you more than the market value on the property, and it's probably not going to happen. That's why sometimes you see buildings that have had a fire loss or some type of insurance loss, damage to the building, and it just sits there and never gets repaired and eventually deteriorates or is taken down and condemned by the city just because the property owners were never able to secure the financing to fix the building back up or repair the building to its former state. It's important to not even think about market value when you're purchasing insurance coverage. You want to be able to get your property back into operation so that you can continue in business or continue to have rent receipts or whatever you're using that property for. And while we're talking about older buildings, some other considerations to think about, and we'll do some videos on these later, are ordinance and law coverage, which if the building is damaged more than sometimes 40%, 35, 40, 50%, the city will say, or the state laws will mandate that the entire building now needs to be brought up to current building codes. And so now, instead of $480,000 replacement or reconstruction costs, suddenly we're faced with an additional $50,000 or so in sprinklers or whatever other retrofitting needs to be done to a structure to bring it up to code. The coinsurance clause is a whole nother equation to be brought in, and again we'll talk about that at a later date. The one thing that does come up from time to time is, what if I have replacement cost coverage and I decide that I do not want to rebuild? Well, very simply, the insurance company, most policies have a clause in that you need to rebuild in order to get the replacement cost coverage. We're not going to benefit you in case of a loss. We'll get you back up into current like, kind, and quality, back into operation if you want to rebuild. If you don't want to rebuild, we're going to take the depreciated value of the property, and that is what your settlement will be, and you can walk away and raise the property, level the building, or whatever you decide to do. If you have any other questions on property coverage, liability coverage, or any of the insurance coverages that we handle, we'll be glad to answer it for you. Just stop by the website and contact us through the form there, insurewithstarr.com, or send an email to office@insurewithstarr.com, and we'll be sure to get back to you. Thanks a lot.